If you want to know what's going on in the US office market, this video's for you. If you just look at the headlines, you'd think office real estate is dead. But when you actually look at what's going on, the story is a lot more nuanced. In this video, we're going to dig into the Q3 2025 earnings of 5 publicly traded office REITs and give you a picture of what's going on in the US office market. We're going to cover Cousins, Franklin Street Properties, Piedmont, Kilroy, and Boston Properties. I'm Brandon Avedikian, founder of Aspire Commercial, a commercial real estate firm based in Houston, Texas. Let's jump right into Cousins Properties. Cousins focuses on high-growth Sunbelt markets like Austin, Dallas, and Atlanta. In Q3 2025, they reported solid leasing momentum once again, with positive absorption across most of their portfolio. Occupancy is holding in the low 90s, and they continue to push rents higher with mid to high single-digit increases on renewals. Tenants are taking a little less space on average, but they're paying more per square foot. The big challenge continues to be tenant improvement costs. Build-outs remain incredibly expensive, but Cousins is sticking with strong credit tenants in top submarkets and not chasing deals with low credit tenants where the TI allowances are just out of control. They've also kept leverage low, which puts them in a good spot to take advantage of any dislocation. Cousins' message is clear in their Q3 2025 earnings. High-quality mixed-use office in the right Sunbelt locations continues to perform very well. Next, let's jump into Franklin Street Properties. Franklin Street is a much smaller REIT that focuses on suburban and secondary markets, and they've been open about how much they've been struggling. Occupancy in their portfolio sits around 69%, down slightly from last year, and leasing activity remains moderate in their portfolio. They signed 274,000 square feet of leases year to date, with most of that coming from renewals and expansions. And so we're actually seeing this across our portfolio that we lease in Houston. It's hard to do new deals right now in buildings similar to what Franklin Street owns because TI costs are so high. And Franklin Street doesn't own buildings that have the highest rents, generally speaking. And so those TI costs make it really difficult. And so a lot of the activity right now is coming from renewals and expansions with your existing customer base and not from new deals with tenants that are coming into the building for the first time. Of the new deals Franklin Street is doing, they're being signed at rents 6% higher than old rates, and average lease terms are about 5.5 years. But those newer deals continue to be elusive. Tenant improvements and concessions are still elevated, but activity is picking up, especially from larger tenants coming back into the market. The company is reviewing strategic options, including potential asset sales or recapitalizations to help strengthen their financial position. They are not in growth mode by any means. They're working to stabilize, but the trend line is finally starting to look a little better for Franklin Street than it did a year ago and before. Next, let's jump into Piedmont. Piedmont had one of the strongest quarters of the group with 724,000 square feet of leasing, their best quarter in over a decade, with over 500,000 of that 724,000 square feet to new tenants. Very impressive. Occupancy climbed to 89.2%, and management expects that to hit 90% by the end of 2025. They raised FFO guidance and are projecting steady growth over the next few years across their portfolio. Rents are up 9% on a cash basis and 20% on an accrual basis, showing solid pricing power, which is something that's very welcome to see in the office market. Tenant improvements average $6.76 per square foot per year of term, slightly higher than usual due to the volume of new tenant deals, which new tenant deals are usually going to have more tenant improvements per square foot than renewals or expansions. Dallas, Atlanta, and Minneapolis led the activity, with full floor tenants starting to expand again, and Piedmont also had $75 million in future rent already signed for leases that have not commenced yet. The message from management is that the market is starting to turn the corner and that the company is positioned to start growing from here. Next, let's jump into Kilroy. Kilroy is mostly on the West Coast in places like San Diego, Seattle, and San Francisco. Their leasing activity was steady this quarter, and absorption turned slightly positive, driven largely by San Diego's life science demand. Occupancy sits in the high 80s, and rent spreads were roughly flat overall. The bigger story here is deal structure. Tenants are wanting longer lease terms and more customizations, which costs more money. And to accommodate these tenants, Kilroy is offering 8 to 10 year terms terms with heavier TI packages, often exceeding $100 per square foot for lab or creative office space build-outs. Even so, those deals still make sense because of the rent premiums in their niche markets. Kilroy has pulled back on new developments and they are reducing leverage, focusing on stabilizing the portfolio before ramping up again in 2026. The key takeaway for Kilroy in Q3 2025, specialized high-quality assets, especially life science, continue to hold value even in weaker office markets. Lastly, let's jump into Boston Properties, the largest office REIT in the US. Boston Properties beat earnings expectations and raised their guidance, driven by better than expected leasing and expense control. They leased 1.5 million square feet in Q3, up 39% year over year, and their occupancy is sitting around 88%. Same property NOI is back to positive territory, and rent spreads rose mid-single digits on a cash basis. Their focus is on premier workspaces, the top 10 to 15% of office buildings in each market they operate. Those higher quality assets have 22% lower vacancy and command 55% higher rents compared to the broader market. And this is a trend that we're seeing in Houston, that pretty much every market is seeing. A flight to quality. Tenants want the highest, best quality, most expensive office buildings, and those most expensive buildings perform very well, and the lower end buildings continue to really struggle. Boston Properties is selling suburban and non-core assets to pay down debt, and they are reinvesting in trophy buildings in the central business districts of New York, Boston, and Washington, D.C. They're seeing growing tour activity in San Francisco and strong leasing from financial services and AI companies in New York. The overall message is that the recovery has started and the top tier buildings are seeing this recovery first. And so in conclusion, a few themes stand out in these Q3 2025 earnings. Absorption has turned positive, occupancy is rising, rents are holding or climbing, and even though TI costs remain high, landlords are getting compensated with longer leases and stronger rent rolls. The gap between higher quality buildings and lower quality buildings is wider than ever. Commodity suburban office space is struggling big time, but Class A amenitized, well-located office buildings are doing very well. And with almost no new construction in the pipeline, supply is starting to tighten just as demand is coming back. And so that's the real story. We're not talking about a collapse. We're talking about a stabilization. We're also talking about a bifurcation in good performance with higher quality buildings, poor performance in lower quality buildings. And so we have a slow, uneven recovery led by the highest quality buildings in the best markets. Let us know what questions you have in the comments, and be sure to like and subscribe for more commercial real estate breakdowns and educational content.